All right, let's continue. So again, welcome everyone to this webinar today with my colleague Jacob, which will going to walk us through the psychology of trading and how you can overcome your emotions. Just some formal information. This webinar will obviously be recorded, and you can find the recording on the website and platform afterwards. Also, just some information. You can also find the slides on the files, so you can see the slides when Jakob is going to walk through it in a couple of minutes. And I think we will also take the questions in the end, if there is something. Can you go to the next slide, Jakob? Fantastic. And I hope you guys can see the screen, but the agenda for today is about trading psychology and how you can overcome your emotions. Jacob will address some of these topics, the emotional foundations of investor behavior. I think he will also look at 10 classic investor mistakes, biases, impacts, and solutions. And then he will map out some of the emotions and biases across the investment cycle, um, and look also at how you can, as an investor, take the maybe most optimal investment decisions yourself. And at the end, we will take the questions that has been asked during the presentations. And yeah, I think that's it. So over to you, Jacob.
Thank you very much, Alex. Just before we start, I will just show you this little brief disclaimer. I will not go through everything word by word, but important to say is just that what we go through today is not investment advice of any form, no recommendations. Please do your own research before doing any investment decisions. What we will do today is purely of inspirational and educational purposes. So yeah, this is not investment advice. So with that out of the way, I will just present myself. My name is Jacob. I am the head of investment strategy here at the Saxo Bank. I don't want to go through all of the my bio here, but I'm working a lot with long-term investment, with how you build a long-term strategy, and also been working a lot with with behavioral finance and the psychology of investing and trading. So that's also obviously what we will go through today. Alex already introduced the agenda. And you should also be able to find the slides, as he said. If you have questions, please use the questions button in the top right corner, and then we will try to go through as many as possible in the end of the webinar here today. But yeah, let's just kick it off with, I will start out with kind of the emotional foundation of investor behavior. So before we start digging into some of the more classical investor mistakes that we see people do, I think it's important that we just set the basics right. And I think, to me personally, I think this field or this area of behavioral economics and finance and psychology of trading, investing, it's by far one of the most important areas, because usually say, like, the most important weapon you have in the toolbox for your long-term success is between your ears. So that's your mind, it's your behavior. So you can say there's no really a secret formula to investing. You can find all the right stocks, you can buy the Nvidias of the world, you can buy all the ones that have been going up and down, and but if you don't have your strategy right, if you don't have your mind, if you don't manage your emotions, you will not be successful in the end. Because you can buy one of the most successful companies in the world that has been, if you look over the last 30 years, a company like Apple. If you look at the drawdowns in Apple, I mean, how much it has been down along the way. I mean, we have seen drawdowns of 60, 70, 80% over the year. So yes, it's nice that you can have thousands of percents, but if you couldn't you keep it for the long run, if you sold out when everything was looking very bad and the stock was down 85% from a peak, I mean, then you wouldn't have those fantastic returns. So just remember that when you hear all of these stories and see the numbers. It's easy enough to look at those numbers, but you only achieve those gains and formidable returns if you also keep and stay invested for the long run, and then also try to behave a little bit rational. But with that out, say out of the way, let's just dive in. Let's talk a little bit about this, say, gut-driven investments or planned investment. This is like, say, the two different ways of investing, whether you are rational, whether you are going through the investment process, whether you stick to your plan or whether you are more emotionally driven. So just imagining two investors, one that is very emotionally driven, selling out when things look bad, trade a lot when things go the right way, and then more like consistently kind of a disciplined investor that goes through, like, even though you have market volatility, you keep paying your monthly contributions or whatever, having a long-term focus. Over time, it's just very clear that the most disciplined investors are the ones who are most successful. Looking at, for example, crashes like the great financial crisis, we saw drawdowns of the general market around like 60%, 57% here. And this is obviously a period where your long-term strategy and also your emotional strength is really being tested. COVID was another big test. I've brought on the right hand side, you can see, if you look at the general global stock market in the year of 2020, you can see that we were actually down, what is it, 32% at some point. But actually the market ended up 14% over the year. So if you sold out when it was really looking bad, then you would have lost on significant return. And on the top of that, on the right hand side, I brought, I mean, how quickly the market rebounded after the bottom of the financial crisis. There you can see that after this bottom of the financial crisis in I think it was in March 29, when the market started going up again. If you had been out of the market for just the first 3 months, you would have lost out on 48% return, and 12 months, 82, and for 2 years would have been 115%. And just imagining that you have been out for, let's say, 12 months, 82%. If we say that on a typical year, the stock market will give you 7 to 8%. That is 10 years of return that you are missing out on just because you have been out in 1 year. So it's very important, these numbers, just to show how important it is to keep the long-term focus and keep your emotions in check. And that is also, I mean, what I started to saying, that you can buy all the right stuff, but if you don't have the emotions in control, then it's pretty difficult in the long run to be successful. I would also like to talk a little bit about why, say, we are the way we are as human beings, how our brains operate. And luckily, we have some very clever people in the world who develop like a system of describing how we think, how we act, and how our minds work. Um, the guys who made this two system brain model, they actually won the Nobel Prize. A guy called Daniel Kahneman. And what this is about is that we have two brains or two systems in our brains that we use when we do day-to-day actions. One of them is system one. That's kind of the fast, autonomous, emotional minds, all the stuff that is just gut instinct, all the stuff that just go on every day. We don't have to think about. Now I just want to take some Coke. That's not something I think about. I was just thirsty. I'll go do something. I will answer a simple question. That's all just something that will happen automatically without me really thinking about it. That's what we call system one thinking. Then we have, and that's very easy to do, very easy for our brains because we don't really spend a lot of energy in it. System two, that's kind of the more slow, rational thinking processes. It's slow, it's deliberate, it's rational. So it's really when we try to carefully analyze something. So you can say, in our normal day life, it's more like when we should really think about something. When it comes to investing, should we, I mean, analyze a stock, analyze a company, a decision that is important, pros and cons, what should we do here? So it's much more deliberate. It's what more energy consuming. And you can say the bad thing here is that our mind, or say our brains, are pretty lazy, you can say. So we want to do as little as possible. Therefore it's easy just to go with system one all the time, because it requires too much energy to go with the very slow rational thinking every time. And when it comes to investment, there's a lot of uncertainties, there's a lot of stress, there's a lot of emotions. And when we are in that, say, field of emotions and stress, our system one, so this, say, gut feeling, tends to overrule. And it's like when you, I mean, from a like evolutionary point of view, if you are in danger on the savannah, and there's a lion running at you, you just have to run as fast as you can, or do whatever you can to save your life. You don't have time to analyze the situation and stand there and say, okay, what should I do here to in order to save my life? Then it's already too late. And it's kind of the same sorry, with the with this when it comes to investment, because there's a lot of uncertainty, there's a lot of market volatility, up and down, news flashing, and this just kind of prompt our system one to take over control. And that just makes some of our decisions very not well thought through. And we are much more prone to emotional responses. We are much more prone to taking irrational decisions, because we tend to base that on our emotions and just a gut feeling. We also call this a knowledge action gap. It means kind of that you know that you should do something, but you do something else. So you might know that buy and hold is a good strategy when the market is uh, is very volatile. But what you do is still that you panic sell in the heat of the moment. You kind of get over it. So this is just, I mean, to know that our brains work this way. I think it's a good foundation for actually doing something about it. Is that, I mean, just become knowledgeable that this is actually how we think and behave. And this is not just something that this is something that everyone does. I mean, no matter how clever, how experienced investor you are, whether you're Warren Buffett, this is something that you do. So this is something that hits everyone. um, then let's go through some of the key emotions that drives the investment behavior, because there's a lot of emotions that is linked, as I said, to investments. The first of them is fear. So it's obvious that if something big is happening, a market downturn, you can become scared. There's a fear of losing money. That can also lead to panic selling, dumping your investments, whatever. Um, and that is also kind of if the market crashes, you kind of hear this fear whispering. Should I get out now before it becomes worse? What should I do? And you might be tempted to sell out and go into cash, for example, something like that instead. And you can say this fear we have also makes us sometimes overestimate some of the risks. So if we are in a very volatile environment, something's going up, then you also tend to overestimate the worst case outcomes, and putting a too high likelihood on those, and that could make you do even worse decisions. You can say on the flip side of that, we have greed and excitement. When markets are booming, or you hear about a hot stock, or you get a good tip, or you read about that some stock is up 10x over the last 12 months, you get just kind of this excitement, you get some greed kicking in. And you can say this greed can make us chase returns quite significantly. So we tend to, like, if we see some stocks going up, we will just buy that without doing a proper analysis first, because we have to, like, get get rich quickly kind of impulse, and we don't want to miss out on something. It's also what say this fear of missing out. And the next one, fear of missing out, is obviously something that is very important, and also um, some, like, the social aspects of this investments. It's just like it's kind of an anxious feeling that if someone else is doing something good, you also want to do that. So you want to listen to the crowd. If everyone is buying into some kind of trend, you read about it, you hear about the latest tech stock, you want to do that as well. Not because maybe you think it's a good idea, but just because if it turns out to be true, then you really want to be a part of this trade. So we have this fear of missing out, and that is really something that is driving a lot of behavior as well. Then the next one is regret. Obviously, also a very strong feeling that we have. This emotion, I mean, comes usually after something has happened or after decision we took. So it could have been, I should have bought this last year. I should not have bought this. Why did I sell? Why did I not buy this stock before? And all of this can make you really make you say all of these feelings can really affect your decisions and how you also behave. And then the last one is pride or overconfidence. That comes out of success. So if you have, for example, a great couple of trades in a row, you start to feel proud. You start to feel great at what you do. You think, okay, just made some pretty good returns. I'm really good at this. I think this is also one of the most common mistakes. It's also one of the common mistakes I have made a lot in my life as well when I started being an investor. That you think, I mean, everything goes. I'm an expert in investing. I'm the new Warren Buffett here just because I made 5%, and then you start to become overconfident. Confidence is good. Overconfidence is not good. So what we do, you start to do is that you might be, you think you have a talent. You think you are so good at picking the right stocks that you start to do less analysis. You start to diversify less because why should I buy 15 different stocks if I know which three will go up, and so on and so forth. And that could lead to a dangerous way of investing where you have a lot of blind spot and you kind of overestimate your own capabilities and underestimate maybe also the luck in some of your past wins, and maybe at some point it will start to go the other way, and then if you are very concentrated you will lose out on a lot of money. So those are some of the most the key emotions that are driving our investment behavior. And as I said, everyone is kind of prone to these investor feelings, no matter whether you are a new investor, whether you are a professional investor, whether you're Warren Buffett, you are say suspect to some of these biases and feelings, and that you can't really do anything about other than being aware of it. There is examples of like professional traders, and some of the I read about it at some point. They have like they are monitored on like some of those Aura rings or something like that, and they have like bands and stuff, such that they can such that traders such that they can see the company that they're working for, those traders, whether they are in emotional effect, whether they are reacting somehow, because it's too dangerous. And I mean, all of this is also linked. I mean, if we have a active manager who is buying into an active fund, you also are prone to this. I mean, you also fall in love with your darlings. You also have a hard time selling your winners and so on and so forth. So that's something that hits everyone. And why is that? I mean, why do smart investors also make mistakes? I have 4 different, say, explanations here. But first of them is what we call loss aversion. Psychologically, that's what we see. We tend to say that we are risk averse, meaning that we don't like taking risks that are unnecessary. We will rather like short gains. But we also what we call loss averse. Loss averse mean that we really don't like losing money. That's just a human thing. And actually we hate losing money so much that in psychology and in research they have found out that losing hurts twice as much approximately as gaining something would feel. So if you lose $100,000, it feels much worse than if it that it feels good to win $100,000. So there is a kind of yeah, a discrepancy there. So losing is really something we dislike, and that is something that is really affecting the way we behave. Then there is something called herding behavior. We tend to follow the crowd. We want to do what the others are doing. Where you talked about the FOMO before as well. This is also something that can create bubbles. It's something that can yeah, raise prices to something that is out of this world and unrelated to fundamentals. Then there is like what we call cognitive overload, because investment investing or this is a kind of complex area. There's a lot of information, there's a lot of economic data, there's earnings reports, charts, tweets, we have truths now. We have the minds of a orange president in the US that is making up a lot of say market reactions every day. So this is a very complex environment to navigate in, with so many decisions, so many information, so many inputs, and that just can you say makes it very difficult to do like an objective analysis. And that's also why investment is really an area where you are so subject to these emotional biases, because it's just very difficult to navigate in for your mind. Keep in mind that now the evolutionary winding, the last one, keep in mind that our brains was made what 50,000 years ago, when we were still going around looking for food. It's not built for like an environment like today. I mean, our maybe we have developed a lot of things, but our brains still work the same way as they used to do back in the when our ancestors was yeah, trying to flee from some of the predators in the field. So yeah, it's just there's a lot of instinctual responses that is triggered when it comes to investing, and putting all of this together just means that even though you are very smart, very knowledgeable, you can also behave very irrational when it comes to investing when the market is crazy and start to become volatile. I mean, talking about a guy like Warren Buffett, I've mentioned a couple of times. He, he also says, I mean, he knows that he is prone to these biases, and he also says it's not the smartest one that succeed in the long run. It's the most disciplined one. It's really about this discipline and being aware of what you don't know. Um, Now we have talked a little bit about all of these different, say, the foundation. Now, as Alex said in the beginning, I want to dive into some of the more, say, classic investor mistakes that we see when we look at different investors, both in Saxo, when we look at all the client data we have, but also when we look at investors in general, in the whole world basically. And I brought 10, and I'll just go through them pretty quickly, so we have time for the rest as well. The first one is what I call overtrading and FOMO, so the fear of missing out. It's really about chasing every bump in the market. So overtrading means that you are buying and selling way too frequently. So buying and selling a lot, and as I said, that's all often driven by this fear of missing out. You don't want to miss the next big thing. You don't want to miss the next stock. So you buy today. You sell it tomorrow. You buy it again the day after. You can buy multiple times at a day. For some investors, it's a good way of investing if you are more like a very short-term focused trader. But for many investors, it's maybe not the right way to invest. That depends on who you are, and of course your sophistication level, and also your long-term strategy or your strategy in general. But you can say, if we look at the general picture, this is not really the most optimal kind of behavior. And you can also see that linked to some of the evidence that we have. We have a very big, there was a very big study done in the US. They looked into, I think it was like 60,000 traders, and they found out that the most trading customers, or the most trading investors or traders, they underperformed the market with about 6.5% per year. On average, and that's really a lot. So that means that, I mean, every year you underperform by 6.5 percentage points to the general market, just because you trade way too much. That's both taking into account the trade, um, cost that there is, but also just that you go in at different at wrong times and go out at other wrong times, you can say. So there is a lot of good reasons for maybe not doing that. Say one of the what's driving this overtrading, one of the things is overconfidence, as we already talked about. People think that they know a lot and then they act on that. If you think that some stock will go up today and down tomorrow, then you, or something is over say priced in the market, then you will react to that. Maybe even when or especially when it's a volatile markets, you will maybe this has become amplified and you will maybe trade even more. So yeah, this is really a big mistake that we see a lot of people doing. Um, what you can do about it is obviously to have some guardrails for yourself. Practical fix is to set up some trading rules. I don't trade within the next 24 hours after buying something or after a big move. I need to see what is the market reaction. I would like to avoid some impulse reaction for myself. So I have some very simple rules. Another thing could be like to have more like a set aside some money limits. You could also set some, say, okay, this is like my fun money, I can trade with them, 5%, 10% for like speculative ideas, but the rest is more like automated, well diversified, solid core. So that could also maybe help you, and this just like monitoring your trade frequency a bit more, and really trying to set up some rules for yourself such that you don't overtrade too much. The next one is what we call the disposition effect. The disposition effect is just a, say, fancy word or fancy term for describing one thing, is that you sell your winners and hold on to your losers. You can say if you do that over the long run, you will end out, if you sell all of the winners because you like all the gains, then you will end up with a portfolio full of losing stocks, and then you could say to yourself, I mean, that's not really an ideal way of investing in the long run. So and that's really what we see, and why we are seeing people selling out of selling out of the winners and not selling the losers is also because of this loss aversion and regret. We don't. If I sell a stock today that is down, let's say 20%, I will take a loss. I don't like that. I don't like taking losses, as I just talked about before. It's much nicer to take a gain. So selling a winning stock that is up, then I tell myself I'm a good investor. I did a good way. If I sell a loser, then I need to book that mentally, that loss, and that just that's not really nice for me because of this loss aversion, and also just to tell myself I was making some kind of failure. So that is really something that we see a lot of customers doing as well, and a lot of investors doing. And what you could do about it is, again, I mean, you see that will go a lot of times here, but be very disciplined, be much more structural, set up some predefined rules. I sell this if this happens, so on and so forth. Maybe also use stop loss orders and stuff like that to set some limits and focus on the process. And if you have a stock that you don't believe in, then you should sell it instead of just keeping bad stocks in your portfolio just because you don't want to take the hit to your portfolio. So yeah, so try not to sell all of your winners, but keep some of them. Otherwise, you will just make your portfolio worse over time, which is not really a good thing. The next one is what we call recency bias. Recency bias is simply believing too much in what's happened in the past, or in the recent past, and then also believing that that is kind of a preview of the future. So we tend to say that what happens yesterday or what happened during the last couple of weeks was probably also tell what will happen over the long run. So all of this recent information is just what we base our decisions on. We also see it, for example, when investors are evaluating whether they should buy a stock. They just go in and say, okay, over the last 6 months, over the last week, or the last trading day, the stock has been up. It will probably continue doing that, and then you will buy it just for the belief that it will go up, but you didn't analyze like the full range. You didn't see, I mean, is this just a very short term? It could also be just a very recent information that you base everything on. So it's kind of just a way of thinking that all recent information is just going to tell you what will happen, and that's also what is, for example, driving up bubbles. Again, if I don't say AI is in a bubble, but now AI has been going up and up and up and up. So people will say, okay, over the last couple of or the last year, AI has been going up. We will probably continue that without doing a more objective analysis of that. So simply relying on the very recent information, you can't do that. So you need to use more long-term data. You need to have a more like a constructive way of looking at your portfolio, and also try to challenge your narrative a little bit, and kind of to counteract this recency. So say, what is the long-term narrative here, not just what is the narrative of, if we look into the last couple of months. And this is also, I mean, we have I was earlier this year, I wrote a piece about how investors are researching, and we also saw there, based on some research done by a university in the U.S., and they also found that the majority of investors, when they invest into something, the research that they do is simply just to look into very short-term price data, and that's not really something that is sustainable in the long run. So that is one thing is as well. Yeah. So keep a long-term focus, not just the very recent stuff. The next one is what we call anchoring. Anchoring is say the way your mind is fixating on a very specific reference point, and it's often a very irrelevant one. It could be the price you bought something at, it could be past highs, it could be something else. So if I tell you that this iPhone costs 5,000 kroner in Denmark, what would you buy it for? Then you use that 5,000 kroner as a reference point, even though it's maybe not linked to the value today, but that's just how our minds work. And that could also be when we invest. If I bought this stock at $100, that's kind of my reference point. That's my anchor. So you always say, okay, now this stock is down to 70. Oh, now it's very cheap, because you think it will go back to the 100. That's kind of the anchor. Could also be increasing, and then you think, oh, now it's now I gain a lot. But you kind of go away from a more like a rational way of analyzing, because you have this psychological anchoring point that you tend to base your decisions on, and it's not really either an optimal way of assessing whether something is good or bad, because it's related to something in the past that might not be relevant. So instead of doing say analysis of if is the price of this stock really fair or not, then you say, relative to what I bought it for, it looks something like cheap or expensive, and then it can lead to bad decisions. So what you should do here is to use another perspective. Don't use those historical or purchase prices or past highs or something like that as the reference, but do a more objective analysis, and really try to diversify away from doing this. The fifth one is what we call confirmation bias. That's also something that is very common, and something that is driving some of our, you can say, overconfidence as well. Confirmation bias means that we look at informations and we seek informations that only support the beliefs or the evidence that we already have. So if we really believe something, we tend to see all of the you can say news or headlines that is supporting that fact. So if I believe that this stock is really good, I will only see all the analysis, all the news that also says that this stock is good, and I will not really be focusing on all the other ones, because they don't know what they're talking about, and they got it all wrong. So why should I care about that? So that's kind of a very risky way of seeing the world, you can say, basically, because it distorts what the actual truth of information. And it's also say, yeah, making this overconfidence even worse, because you really believe that all of this information and all of the information out there is just confirming your own story. So if you got something wrong, you will just get it even more wrong, because you only see the stuff that is really not trying to contradict whatever you believe. It also comes from this, what we call cognitive dissonance. And what we also call availability bias, but kind of the cognitive dissonance is kind of that it's uncomfortable when we encounter something that contradicts our beliefs, and it's really not a nice thing. So we try to avoid that. And the availability is that, I mean, we tend to only read the stuff, as I said, that kind of tells the story, some of the stuff that we're already familiar with. There's also something, for example, that is driving the home bias that we will talk about in a second. We will only see, I will only read, based in Denmark, so I will only read about Danish stocks. Obviously, that will lead me to only buy Danish stocks, because that's the only thing I know about. So try to broaden out your horizon. Try to be the devil's advocate. Use checklists. Use other, to say, information that is trying to not just agree with you. It's a very good idea. We already talked about this overconfidence here, but this is really something that is important, because it's something that is driving a lot of other bad things, because we really think we are way too good, makes us take way too much risk, over estimate our own abilities, underestimate all the familiar risks, and that's just really something that is good. We have already covered that quite a lot. It leads to this excessive trading. It leads to that we only see the informations that we have. It leads to the fact that we under diversify. Um, so it is really something that we also, this illusion of control, meaning that, for example, that we tend to believe that something that happened, maybe pure to luck, is something that we can control, or something that was done with our say skills or actions. So what you should do here is really track your performance, try to seek some more objective feedback, set some limits for yourself, make some checklists that really help you reduce some of these overconfidence risks, because it's really an ugly one. Then there is one called not overconfidence, herding, and social proof. Herding is kind of this doing whatever everyone else is doing. We talked about it a bit already with this. I mean, I brought this little illustration here on the right. I mean, I don't know where we're going, but looking from this crowd, it looks to be good. And this is also kind of what we see sometimes from investors, that I actually don't know what happens in this GameStop stock or AppLovin or whatever. I mean, now I'm just making some random stocks up, but I don't know what happens to this, but I can see everyone else is talking about it. Everyone else is buying. I should probably buy that as well. And this is just something that creates a lot of exuberance and you say overhyping, where people don't really know what you're buying, but just buying what everyone else is buying. And this is really something that is driving behavior, as we talked about in the beginning. And here, what we should really do is try to focus on more independent analysis, on plans. I mean, don't buy something. One of the main pieces of advice from Warren Buffett as well: don't buy something you don't know what is. You need to understand the company. You need to understand the business. Otherwise, you shouldn't buy into it. So try to really do some more contrarian thinking and say, okay, what is it that we are buying here, and why, instead of just jumping on the ship. Next one is home bias. I already talked a bit about that, but if you say that's kind of just sticking to what you're familiar with, buying the stuff that you know about, buying all the stocks in your home market, instead of having a more global view and a more global focus. This is something that investors are prone to all over the world. I mean, but the issue is, of course, if you are in a small market like the Danish market where I come from, and you have many customers, many investors in Denmark have maybe a home bias around 60 to 70% of the entire portfolio is made up by Danish stocks, then you are very, very exposed to a very narrow market. I read a piece by the EU Commission. I think Romania was the worst place in Europe, or worse, the one that has the highest home bias, up to 90%. There's a lot of structural reasons for maybe why that is, but just, I mean, a very, very small market where you have all of your eggs, to say it. So it's just a very risky way of say investing, because a home market can be very tied to a few companies, a few sectors, and if something happens in Denmark, for example, it wouldn't affect the rest of the market, but it would affect your portfolio. We are in Denmark very exposed to healthcare. Ask all the investors in Denmark about the Novo Nordisk performance over the last couple of years, or the last year in particular, and what that has meant to the Danish stock market in general, and to all the portfolios of the Danish investors. So thinking about, yes, you have a very strong market. Now we take Denmark again, but the Danish market make up less than 1% of the entire market. So basing all of your investment in a very narrow market is just a very risky way. So try to have a much more broad framing is really something that helps, and broaden out the perspective. Use international funds and ETFs, for example, as the foundation, and then you can start picking single stocks in your local market if you want that. But don't do all of those eggs in one basket.
Exactly, Jacob. Jacob, I think also it's a very interesting point that you have right there. Also, could be a very interesting exercise for you guys also to maybe compare like your local index to other indexes around the world, also just to emphasize how the development has been, and to see that there actually has been a very huge difference in terms of I know Denmark as well. If you look at the Danish C25, but just also in general to like see the performance on different markets.
Exactly. So yeah, it's a really, really important part, and the smaller your home market is, the more important obviously it is. I did earlier in my career, I've done some research into this as well, and we also have what we call a local home bias. So you also buy something that is close to your home. So if you, for example, again, lives close to a industrial company making wind turbines, then you are more prone to invest into that, because that's what you know. So there's different layers to this, and it's just, yeah, also just that what you read about is also what you buy. So if you only read about tech, then that's probably also what you will only buy. So try to not only buy what you know, but try to broaden out your horizon. I will jump to the next one, go through that very briefly, but that's what we call the sunk cost fallacy. Sunk costs mean that, I mean, whenever you have uh, invested into something, whenever you have spent some money, you can't get those money back. But we tend to, I mean, keep throwing good money after bad things. Now I took this guy that is reading a book. If you started out reading a book that you don't like, some people will just continue reading that book because now you already started. So then just wasting more time on something that is very bad. That could also be just, now I started investing into this stock, and I don't really like it, but now I already invested a lot of money into it. So now I just might as well just keep doing it. So try to be a more like, have an exit plan, try to have like stop rules, have more forward looking mindset. Don't just continue something just because that's what you have been doing for the last year or so, but have a more like learning from your past mistakes, basically, and a more rational way of thinking that. And then the last one I will go through here is what we call myopic loss aversion, or just loss aversion. But myopic just means that you you combine loss aversion with something that is very short-term focused, meaning that taking those two in combination, that you are extremely focused on not losing money, but at the same time very focused on the short run instead of the long run, then you are just like, okay, everything is extremely dangerous. Oh, you're losing money. You overreact to some very short-term moves, short-term reactions in the market, and that can lead you to very bad decisions. Lead you to sell out whenever everything is going south. It could also lead you to checking in on your portfolio every time, or every day, every second, every hour. So if you check your portfolio 20 times a day, it's just very difficult to keep a long-term focus. So, for example, think I have a 15-year horizon. Maybe I shouldn't check my account 15 times a day. Maybe one time a week, one time a month is okay. Because nothing in the short run significant will change my long-term strategy. So if you're very focused on the very short run, you will be also prone to making more inoptimal decisions over the long run. So try to broaden the time horizon, focus more on the long term, and automate this some of your decisions is very important here. I will now try to I will actually skip this one because this one was just about, I mean, where in this process we make mistakes, and you can say it's actually through the whole cycle, in the investment, in the idea generation phase, in the interest state, in the holding stage, in the adjustment. When you adjust your position, when you exit, you're prone to different decisions and different biases all along the way. We have just been going through a lot of them. So it's not just something you can do whenever you look for a stock. It's something you need to be aware of throughout the entire process. You will get the slides afterwards, so you can read through this yourself. But I think it's important that we just look into what you can actually do about it. We have already talked a little bit about some of the guardrails, what you can do, but I just think it's important. All of this, it really comes down to something about automating your decisions, making limits and constraints for yourself, doing a solid process, rituals, and try to remove as many frictions as you can in the process. So in the automation, I mean, try to make, maybe don't take decisions every time to invest. Maybe you should automate some of it. Maybe you should automate your the dividend reinvestment, so you don't have to think about it. Maybe you should automate the monthly investment, so you don't have to think about it. You don't have to take decisions. Do like simple rules for yourself, saying that, okay, I should rebalance my portfolio every half a year. I should go through it, and make some rules for yourself. There could also be the limits. Could say something, I can't have positions larger than 5-6%, let's say that 10%. I can't do this and this and this. I can't do more trades than 5 per month, except something is extraordinary happening. I can't spend more. I can't have more than 10 different single stocks in my portfolio, something like that, so that you keep focus on what's really important. And then the process and the ritual. I mean, really go through a solid process checklist every time. Okay, what is the story here? What should I focus on? Why do I buy this? Why do I believe in this? Maybe have like a decision journal, writing down like, what is the hypothesis for this company? What is the hypothesis for this stock, this case? So you can go back. So whenever you have high volatility, whenever a stock is down to 15%, you can go back and say, okay, why did I buy this? Has something fundamentally changed since I bought it? If not, maybe I shouldn't sell it. If yes, something has happened, maybe you should do adjustments. Then it's much more easy for you to go down and have like a more rational way of doing it. And then in the end, try to remove some of the frictions. So maybe you should have like a cool off period. Say, okay, I need to wait 24 hours before I do something. I need to have if I want to buy a stock, I should have it on my watch list for 1 week to think about it. Maybe I should have other like controls in place, such that because I know I'm really prone to some of these mistakes. And then before we go to the questions, I just want to tell you about Ulysses, because it's weird to link that with with investment, but Ulysses from the Odyssey by Homer. It's very old thing you probably read in school. He was returning home to I think it was the island of Ithaca or something where he lived after the Trojan War, and he's there's a lot of bad things on this voyage on the way home. One of them is that he comes to this place where you have all of this what they call the sirens. They are singing very beautifully. They are but they will make you commit suicide. So you really want to hear it, but if you do, you will turn crazy. So what will he do? He uh, he really wants to hear this song of the sirens. So he said to all of his men that they should put wax in their ears, and then they should tie him to the mast, and then he can hear all the singing, because he knew that if he didn't take these guardrails, if he didn't prevent himself from acting on his emotion, he would end up throwing himself out into the water, and he will end up dead. And because it's kind of the same, maybe not that aggressive with investments, but it's just like, you know that you have, I mean, the sirens will sing. Markets have sirens. There's fear, greed, FOMO out there. So if you don't have these pre-commitments already, you know what to do, then you will end up with a problem. So try to do set some rules for yourself, and have like a simple playbook where you write down what is your goal, what is your strategy, some of those guardrails and mindset. Write down what is my goal with investments. You can write down in your strategy, and I think it's a good idea to write it down. It seems very old school, but it's easy to go down and say, okay, how much risk will I take? What is the volatility that I would like or what will I do when it comes to volatility? It's much easier to plan when everything you can say, in good conditions, and then you can go back to that plan, and then you can use that as kind of the reference. And this kind of playbook and strategy where you've written everything down also helps you with this structural rule-based decision making, and automating everything. So it's really a good way to kind of make some helpful guardrails for yourself, such that you're not prone to this, and do like Ulysses did, and taking all your um, taking your precautions, because you know that we will probably all end up doing emotional mistakes if we don't do these guardrails. So try to write this down and have a much more structural mindset, and do that when over time, whenever you have when you have time and you don't like in the grasp of your emotion. So that's just a very good piece of not advice, but just one thing that you can consider doing. With that said, I think I have been through a lot. I've been talking a lot now, so we'll leave some room for your questions if there is. Um, it actually seems like most of the question is already have already been answered. So
Yeah, I think so too. It seems like you covered it very good. I think it was quite interesting to hear about all the emotions that people might have when trading. A lot of nice tools that can be beneficial to use to manage emotions when trading. I don't see that many questions right now.
I think no, the rest, those that has been already been answered.
Yeah, I think so too. And just to emphasize, this recording will be up in the platform and on the website as well afterwards. And then, yeah, I think that's it. Thank you very much, Jacob, for the presentation.
Thank you for tuning in, and remember that you can find all the slides, and you will get a link to the recording afterwards.
Perfect. Thank
Have a
you.
nice
See you
day,
guys in the next one.
and happy trading.